Hello and namaste. Good morning, good afternoon, good evening, everyone. We have a global audience joining us today. I am Vijay Bhandari, Chief Operating Officer of Noesis Capital. On the behalf of Noesis Capital, Ngage and FICCI, I welcome our chief guest, eminent speaker, and audience joining
I
us
cannot
today.
hear anybody.
Our chief guest of the event is Mr. Souvagya Mohapatra, Chairman, Eastern Region Tourism Council FICCI, and Executive Director, Mayfair Hotels and Resort. I invite Mr. Mohapatra for a welcome note. Over to you, Mr. Mohapatra.
I welcome everyone to this workshop on sale and lease back model, an alternative avenue for project funding. Tourism and hospitality sector has become the backbone of our global economy. Tourism and hospital sector in India contributes almost 9 to 10% of GDP and creating one in every four jobs. It continues to be the engine of our economic growth. But for the engine to function efficiently, it requires fuel. And in our case, this fuel is funding. Funding is the mechanism that provides funds at the reasonable rate, has played a crucial role in the growth of the developed countries. And India, as a developing country, this remains critical to realize our global goals and visions. But speaking on the aspects of funding in the Indian context, there are many reasons to it. The cost of institutional credit in India is too high in comparison to the developed countries. Then there is a prohibition of funding of land purchased by bank, which is yet to another major constraint as the land acquisition cost for the hospitality projects ranges anywhere between 25 to 35% of the total project cost. Thereafter comes the issue of doubt amongst the public. When it comes to lending due to the NPMS and the non-inclusion of hospitality sector under the industry tag. Over and above this concern, we all knows about the scale of devastation that COVID has done on our industry. With revenues being zero for over months now, with still no clarity over the future, the issue of funding assumes much important, and there could not have been better time to explore on this topic. One of the effective way forward to this issue of funding in hospitality sector is the sales and leaseback model, now popular in European and American markets. Indian market hasn't yet seen this funding concept on a larger scale. In simple terms, in a sell leaseback agreement, an asset that is previously owned by seller is sold to someone else, then leased back to the first owner for a long duration. In this way, a business owner can continue to use the vital asset but do not own it, therefore making it a very promising alternative method of capital in our country. When banks are getting reluctant to lend, this is an option worth exploring to the overcome stagnant equity. What is better about this concept is that it hardly has any disadvantage. I hope that as we go ahead about this model of financing, it will gain more currency and strengthen the Indian market. I end my note here, leaving to our esteemed panelists to explain the finer aspect of this model and the suitability of it in the Indian context. I hope all participants will find this session interesting and engaging. My compliment to Noesis Capital Advisor and Engage Hospitality for taking this initiative to organize the workshop in association with the FICCI. Thank you. Thank you very much. Thank you, Mr.
Uh,
Mohapatra.
Thank you very much, Mr. Mohapatra, for setting up the tone for the event and encouraging words. On the behalf of Noesis and Engage, I thank you and the FICCI for partnering with us for this event.
Thank
Thank
you very
you
much.
so much. And over to you, Nandi. We can start with the panel discussion.
Thanks, Vijay. Thank you very much. Thank you, Mr. Mohapatra, for your wonderful view on this subject. Thanks a lot. It's been very encouraging to hear from you, from a senior hotelier like you. Starter sale, hotels and resort on starter sale and lease back module. This is something a very prevalent and ongoing concept in the Western world, in the developed market. But when we come to India, it is at a very nascent stage. We have few success stories, but I can and you can count on your fingertips. but the country has a huge potential on that. Due to COVID-19, the financial institutions have a very conservative view on financing the hotel project, especially if you are at a greenfield stage or at a planning stage. Now, what are the alternate avenues which we can work around to raise finances to develop your projects? Hotel and resorts, startup sale and lease back, one such module which may work if we execute it rightly. To discuss this in detail, we have a very eminent panelist today with us, starting with Tanveer Shah. He is the founder and CEO of Blue Triangle Capital. Tanveer is an instructor in Harvard, and recently he had joined hands with Jatia family to further develop this business model in India, and he's raising finances for this subject, for this project across the Middle East. Tanveer, we're gonna discuss these very fine points from you from the financing aspect of this entire business model. Looking forward for your insightful views on this. Thanks for your presence and being with us today. After that, I have with me Suhail Kanapile. He's the Chief Executive Officer of Fern Hotels and Resorts, one of the most young chief executives in our hospitality industry and a very vibrant and influential voice in the country on the hospitality matters. Suhail, thanks a lot for your presence. I have with me Santhosh Kutty. He's the Chief Operating Officer of Mahindra Hotels Division, and he's having experience of more than 3 decades in hospitality and worked in past with Taj, with The Park, and now is with Mahindra Hotels. Thanks, Santhosh. Thanks with us. We're going to have an interesting session with you today. I'm very confident of that. And after that, I have with me Nikhil Sharma. He is the area director of Wyndham Hotels and Resorts. Wyndham is one of the largest franchise hotel company across the globe with 10,000 plus hotels. And he's taking care of the South Asia market and one of the most vibrant voices in the country when it comes to the hospitality subject. In addition to this, I have Mr. Rakesh Israni with me. Mr. Rakesh Israni is the managing director of Pacifica companies in the country. He has experience of operations and development in Gujarat, Karnataka, Telangana, and NCR, and very experienced hotelier and developed some of the finest hotels in the country. And right now, working on this business model of hotel startup sale and lease back in the country in a city called Dwarka. Thanks a lot for your presence. So, Suhail, starting with you. So, how's the business shaping up for the leisure market in last couple of months?
So, actually, since we've reopened June 8th, the leisure segment has been the first one to bounce back. We've seen tremendous footfall. It's been coined revenge tourism, revenge holidays that are happening. Okay, and that's actually what's driven some of the leisure properties. While business hotels are seeing business to the extent of only 30% of their pre-COVID levels, leisure properties are in the region of 80 to 90% of their pre-COVID levels. So they're much better off right now. But this being said, it is pocketed to certain leisure markets. I think certain leisure markets in India still haven't picked up, like the hills, and even Goa as a destination still hasn't picked up to the extent the ones that opened earlier have the advantage to their side.
Thanks. So you recently launched a large project of approximately 200 keys in Bangalore with the brand name of Zing, which I understand is on a startup sale and lease back module. Can you explain, while operating a product like that, from the operations perspective, do you feel any challenges when it comes to startup sale and lease back hotel vis-a-vis conventional hotel?
Sure. So actually, Bangalore is not our first stint in this segment. We started Strata sale and lease back with a project in 2005, actually, which was a project in Gurgaon called Hillview. And happy to say that it's matured. The market has matured a little bit since those times, because at that point we still had dual occupancy, where we had people who were residing in the building completely, as well as a portion of it that was used for sale and rent back. So the one that we're doing right now, the 3 properties that are currently on the sale and lease back model, we've got one in Calcutta, one in Bangalore, and one in Anjar. All of them are purely sale and lease back. That means a person doesn't have the right to permanently reside in the premises. And that actually makes it very similar to that in terms of operation, makes it very similar to that of a hotel. The 2 challenges that a management company or a management faces is, one is, you don't want to get into a scenario where you're dealing with multiple owners. So for that, buffer level that has been created, whereby there is a buffer company that has leased the entire assets back into it, and you're only dealing with that company from a management perspective. Okay, so that's probably the biggest challenge, and that this way has completely overcome that aspect. Okay. And then the other part is, people residing in the property. Now, if your agreements are tight and you've ensured that during the sale process itself, you've linked in the lease back, that challenge is taken care of.
Thanks, sir. Thanks for your inputs and thanks for sharing your experiences on this front.
Already
Tanvir, coming
unmuted
to you
mic.
for the.
Can you hear me?
Tanvir, coming back to you, from the Strata sale and lease back, in the interest of the audience, can you explain how this entire business model worked for you guys when you are executing this in the country?
Sure. So the easiest way to explain it is take a 100-room hotel. Historically, one individual or one group or one entity would own the entire asset. Now what you do is you go to, let's say, 100 different individuals and sell those individual rooms with full title. So it is fully their asset. That individual room is their asset. And then they give a long-term lease back to an operating entity to run it as a hotel. So essentially in a residential apartment, for example, you would rent the unit out for 12 months, 365 days. Instead, here you're renting it out for a daily night. To manage that sort of 365-day daily rental of 100 rooms, you need an operating company. So in that sense, it's relatively similar to what residential used to be for investors. So you buy one residential unit and you rent it out. Aapko yield milega 1.5%, 2% if you're lucky. Whereas here you run it as a commercial operation, you rent it out every night. You get a much higher net yield after giving the operator his margin as well. So in that sense, it's something that everyone can understand and digest. So it's a residential component asset that people can understand, run as a hotel. So that's why calling it, we've termed a word, or the Vaibhav, my partner of the Jatia family that runs Rhythm Group, it's called Resitel, residential hotel. So condo hotel, strata hotel, something that the West has used. Given that the Indian consumer is used to investing in residential, we've created this term or coined this term called Resitel, residential hotel. So it's a relatively simple concept with a higher yield because you run it as a commercial operation.
Interesting, Tanvir. You guys have already executed a couple of projects in the country, in the Western region. What type of returns retail investors are getting from these projects?
So usually 3 to 4% higher than the risk-free rate or the sort of fixed interest rate that you would get from a bank. In Dubai, it's usually about 6 to 7%. Dubai is known for a lot of strata sale successful hotels. Address Hotel is something that everyone has at least seen, even if they've not maybe know the name. But everyone in the industry knows Emaar hotels, and the Address hotels were all built as strata sale and leaseback. In India, our partners, the Jatias, the Vaibhav Jatia and Ashok Jatia family have built this 84-key hotel in Lonavala, which is called Rhythm Lonavala, which is again giving about 8 to 9% net return to investors after the operator's margin. And this has been running successfully now for about 16 quarters.
Appreciate it. Thanks for your inputs. Nikhil, coming to you. What's your view on strata sale and leaseback business model when it's come to India perspective? Are you doing any projects in India on this business model?
So the short answer to your question, Nandi, is yes. And we've actually partnered with Mr. Israni, who's unable to join at the moment, but our Hawthorne Suites in Dwarka is a sale and leaseback model. I just wanted to speak a little bit about what we do internationally, because we have a lot of learning, whether it's our hotels in Australia or the hotels in Dubai, where we're fairly successful. But the backbone of Wyndham is actually RCI, which is our sister concern, Wyndham Destinations, which is actually the world's largest vacation ownership rental company in the world, right? So we have a lot of expertise and learning that we've actually used in the hotels division, and have been pretty successful in US, Australia, Middle East, and now we are bringing those learnings into the country. Hawthorne Suites was our first model that we've implemented, and hopefully soon enough we'll have Ramada residences in the near future.
Interesting. Yes, Nikhil. So you were telling about your global site. So how many projects you have across the globe on this business model?
So, Nandi, we are publicly listed. Wyndham Hotels and Wyndham Destination are both publicly listed on NASDAQ. I can tell you, Wyndham has 9,000 plus hotels in 90 countries. Wyndham Destination has more than 4,300 resorts in 110 countries. A lot of them in successful countries like US, Australia, Middle East, work on a sale and leaseback model. We are a franchisor, so we work with the developer and we don't work with the end consumer. That said, from a legal perspective, we do vet the individuals, and we have a say on the individuals who are actually buying into that property.
Interesting. Nikhil, in comparison to conventional hotel, this particular transaction need to be structured well so that there's no issue with the operator. And at the end, operator is the one which brings life to the property from the long-term sustainability point of view. So what are those special clauses you keep when you are signing a contract with the project which is on Strata sale and leaseback to protect you as an operator and to make sure that relationship goes long-term in a very smooth manner?
Right. So let me just take a step back. Firstly, the developer profile is extremely important, right? And the ability of that developer to sell that project in a certain market. Now, those are the two givens. The third piece is that if a developer wants to do this, is he legally sound? Because the contracts, especially in this part of the world, because we are fluid on strata sales and we are not as well defined as the West on strata sales. How good is the legal contract and the legal binding for the end consumer? We as a brand will obviously ensure that our interests of the brand are protected. From a legal perspective, is the contract that the developer has with the individual in line with our standard clauses, and making sure that not only the brand but the service that the developer ends up giving is as per our brand standard. So it actually keeps, it's a waterfall effect, Nandi, to answer your question, and it has various permutations and combinations, but we completely control that process with the developer.
Interesting. Thanks, Nikhil. Thanks for your input. Santhosh, coming to you. According to you, what it takes to make this particular business model work in the context of Indian hospitality industry?
Interesting. See, this model, in my view, is about two parts: hospitality, and I think all of us understand, obviously, real estate. And any business model is built on trust, correct? So there are, I think, a few parts. Trust is the most important. The second is obviously regulation in some parts. The third is in terms of people understanding the model, the investors getting returns, or should I say being able to secure returns in some manner. Those are important in my view to be able to make this really work. Also, from developers' point of view, nobody today is so clear about in the country today about how this model works. Developers are apprehensive, operators are apprehensive, investors are apprehensive. So there is a learning curve which the country needs to go through to be able to get to this model, so to say. So from our point of view, Nandi, you know that we are a vacation ownership company. We are, of course, an evolved model of strata sale, meaning we don't do strata sale, obviously, but we are an evolved model from there selling vacation ownerships. We do strata sale, in Europe. One of our companies in Europe, they do only this as part of their business. So it's not a new thing for us. We ourselves have done one project. We signed up a project. It should open in Kerala next month or 2 months. We have another 2 projects in the pipeline in the same manner, which are partnership projects with developers. So that's what it will be.
Thanks, Santhosh. Thank you. Tanvir, coming back to you, you mentioned that typically in your existing projects, you're giving 8% return to the retail investors who have invested in your project on starter sale manner in the units. As you tell, in your words. Now, these lease contracts, what you have with the retail investor, these are fixed leases or these are variable leases? With variable lease, I mean to say, is it revenue share what they get, certain percentage of the turnover or certain percentage of the profitability, or you are giving them fixed returns? How it works for you?
So it's a revenue share model. Obviously, because it's a long-term play and you want a long-term lease from the buyer or the owner, you essentially want people who understand that this is a hospitality game. They should believe in the tourism potential. They should believe in the rentability of that asset and its location. So they're definitely partners in the sense that they are co-owning part of that asset. And it's definitely a revenue share play that we feel is the practical way forward as well.
It's okay. Yeah, it's logged in as well.
Interesting. Interesting. So Tanvir, one more question to you. That what's the tenure of these contracts which you have with your retail investors?
So these are 15-year plus. Again, as I said, it's a long-term play. To have visibility as an operator, you need at minimum a 15-year tenure, which is usual globally as well.
And what's the typical revenue share arrangement you have in terms of percentages?
So, as Nikhil likes to say, they're a listed company. We are not, but we're definitely regulated by SEBI. So we have launched the first SEBI regulated fund purely to build strata sale and leaseback assets. The fund is targeting 20% plus IRRs for fund investors, which is the stage we are at.
So how's the experience in raising funds in the Middle East for this particular new venture? How is it going on because of COVID? Do you feel any challenges in raising funds, or the conversations are going well so far?
So the conversations were paused in the initial stage of COVID, where no one really knew what the next month or next week will bring. Now that sort of COVID is part of life and people have sussed out, as Sohail also mentioned, there is a sort of passion for tourism, or what is being called revenge tourism. People are traveling just for the sake of traveling, and investors are seeing this. So there are several smart investors, contrarian investors, who understand this is the time to buy distressed assets. This is the time to invest. So we're seeing some serious interest from investors to go with the strata sale and leaseback model, which is a far more resilient model from a financial perspective.
Interesting. Appreciate them. Appreciate your inputs. Nikhil, coming back to you, in your development pipeline, how many such projects you regularly and get an opportunity to evaluate, which are on strata sale and leaseback?
Well,
what type of development pipeline is from this particular business model?
So, Nandi, let me answer the pipeline question first. I'm hoping that Tanvir and I have a chat after this for rhythm to start with. Like I said, we're looking at. Thank you for that. Like I said, we are looking at some active projects in strata sale. We are looking at, like I said, hopefully in the near future, getting in the residences model into the country, whether it's a Ramada residence or a Wyndham residence, and that will obviously be with a developer. And from a brand perspective, it's extremely important for us to make sure that the multiple owners that are getting the lease are taken care of, and the exit clause for them. I think Mr. Israni is now fully video capable and audible, and our engagement with Hawthorne Suites in Pacifica is actually something that he can talk about if he can hear us.
Sure. Yeah.
I don't know if you can hear us, Mr. Israni.
Mr. Israni, can you hear me? So my next question is actually towards you. Can you unmute yourself?
I can hear you guys.
I can't hear you, Mr. Israni. Yes, please go ahead. Can you hear me?
I think the administrator has muted.
Super. Great. Finally, we got you.
All right, guys.
Great. Firstly, welcome for this panel discussion. We have already introduced you to our entire audience. So, Mr. Israni, you have a vast experience in hotel development in Gujarat, in Karnataka, then Telangana, NCR, and you have worked in US for your Pacifica company's operations and development and strategy as well. So from developing a hotel in Ahmedabad, which is a conventional hotel, you moved to a Strata sale and leaseback module in Dwarka. Any specific reason why, as a developer, you choose this business module?
So as you guys have discussed it in the past, and the strata sale model works better for financial closure in today's market conditions. So we were wanting to try this out for a long time. The market's not mature enough in India to understand this product still. So we had to package it well enough so that it's not unbranded. It has a proper management, proper yield for the investors or the strata sale owners. And once we figured out all of that, then we started this model. We are coming up with that same model in another 3-4 cities. We have Gir Forest, we have Amritsar, we'll do in Lonavala, we'll do one in Udaipur. We have these acquisitions already done. So we're going to do the same strata sale model in these 4 or 5 more locations.
Interesting. So how's the, coming to your Dwarka project, which is already a partly operational project, I believe it's a 200 plus piece, which you have proposed to develop over there, out of which 1/3 of the inventory is operational. Okay. So how's the sale momentum over there when it comes to retail investor coming and investing in the individual units?
So we're almost sold out on the units that we wanted to sell. So the way it works is we've sold about 100 units and we own 60 units. So we've not sold the entire inventory. We believe that unless a developer owns or retains certain inventory, the investors don't believe in that project. So we want to retain some portion of the inventory. So we've retained about 60 odd units and sold about 100. So we're finished with the selling of the units. And about 100 odd units are already online, the inventory.
Interesting. Brilliant. So is there, Nikhil, from your side, as you are the brand on this particular property, is there any clauses from your side that where you want that certain inventory should be kept with the developer? Though as a developer, Mr. Israni is saying that he's very much keen himself to keep it. But as a brand, is that a clause which you definitely push the developers to agree upon?
No, we don't stipulate that. That's up to the developer if he wants to do 100% strata sale. As long as, like I said, as long as both legal entities are protected and the individual investor follows the guidelines that we have laid as a brand in protecting both the developer and us. The issue in our part of the world is most investors do not get the kind of returns, and that's why we've not seen an uptake in strata sales. But hopefully with brand names like the Jatias and Mr. Israni pushing the strata sale in this country, you will see more and more development in this segment.
Mr. Israni, what do you think that right now you're doing this particular business model in a leisure location, pilgrim leisure location, and you mentioned Gate, which is also again a leisure. Do you think a model like this is workable in metro cities for business hotels?
So as I said, we are doing this in all leisure locations right now to start with. But this model definitely works in the urban cities or the tier 1 cities, business cities, meaning Dubai is a classic example. Singapore is a classic example. Yeah. You need to have a right blend, right ingredients to make it work in the cities. The right brand, the right location, the right yields for the investor. So right now, with the current market condition, there is a larger elasticity of demand and pricing flexibility for leisure locations. And the investor is also looking for so-called fringe benefits along with the yield. The fringe benefits are the vacation swap program with the RCI or his own free night stays, allowance, which is, we are allowing about 21 nights, 7 with RCI and 14 at the resort itself. So when you're doing this at the leisure destinations, the investors are, coming forward more because they feel there are more fringe benefits than the urban cities.
Interesting.
But this model can definitely work.
Great. So what type of returns these investors can expect from a project like Dwarka and Ngage?
So on a typical a 10-year pro forma, which typically a developer or a hotelier runs, they should be able to get about in low teens, maybe 12, 13% return at least annualized, averaging it out for 10-year period.
That's a very interesting one because I don't think any other asset class gives that type of returns to retail investors. This been executed, I think, effectively in the right manner, this can be really a very prominent asset class in the country.
So any performing hotel asset is able to give 12% return to its lender. Why shouldn't be able to give it to its investors?
Well said. So when you're doing Strata sale, the common areas undivided share is also coming to those investors, or that's not part of the deal?
No, so strata sales have to be, the planning has to be done very meticulously. So what we're doing is we're doing horizontal development. When I say horizontal development, meaning we are doing only villas. So that way we don't have to distribute the common areas to them, but they still have their roads and access to the common amenities. But our typical model is we're only selling them the villa and then leasing it back on a long-term 29-year lease. That's our model. So there is no need for public areas to be given as an undivided share to the villa owner, because they're part of the project and they're always going to be as amenities for next 29 years as part of the lease terms.
Interesting. And is there any minimum guarantees when you are selling these units to the investors for a certain period of time, or it's purely on revenue share?
So we don't give any guarantees. It's pure revenue share. Depending on the type of the unit that they buy, the revenue can go on, and that also is a pure room revenue share. No F&B, no profit share. So we have to keep it clean and crisp. A lot of developers have gotten into trouble when you get the investors or the strata unit owners get into the actual bookkeeping and the accounting and the profitability. So we keep it very clean. It's only room revenue share. So anywhere between 32 to 42% is what they get as a room revenue share, depending on the type of the unit and the cost of the unit that they buy.
So let's say you have 100 rooms and the occupancy of 60% for one particular day. So 60% revenue, 32% of get evenly distributed among all the 100 owners. That's what you're saying, right?
So we've created a concept of RevPAR per square feet in the leases.
Okay.
Everybody understands what is RevPAR. So we've done RevPAR per square feet. So somebody puts in 1,000 square feet villa and somebody puts in 600 square feet villa into the pool. So the total square feet in under management is 1,600 square feet, and they get their 600 and 1,000 square feet RevPAR.
Appreciate. That's pretty insightful, Mr. Israni. Tanvir, coming to you, what's your development strategy when you're raising funds? I'm sure you have an aggressive plan in the country to develop more projects. Are you looking purely leisure? You're looking urban tourism, or you're looking even for business hotels?
So primarily leisure is where the uptick is in tourism demand. So that is our primary focus. Urban dwellers going for a weekend getaway or a long week-long getaway, 4 to 5 hour driving distance from an urban center. Looking at Western India focus, so Maharashtra, Gujarat, Rajasthan, Goa is where we are focused at the moment. There's also a question you asked earlier about city hotels, which so on the leisure side, the positive is that that's where the tourism demand is. However, most of the buyers are urban buyers, and real estate being such a physical asset class, it's always easier to sell an asset that is within driving distance. So if you look at a Bombay dweller looking to buy physical real estate, and let's say strata sale and leaseback is something he's interested in, if you could take him to the asset in 5 minutes and he can physically see it, there's a higher chance of converting that sale. But of course, the Indian demand is largely leisure driven. So our fund strategy is leisure driven. It's a 200 crore AIF, CAT 2. Category 2 SEBI AIFs are the real estate AIFs. And we're looking to deploy that on the Western front. And all of it, 100% is to strata sale and leaseback hospitality assets.
Tell me that as per your plans and as per your experience of the existing projects as well, at what stage you open up the sales bookings? After a certain percentage of the project has been developed, or it at a greenfield stage, or once the showcase resi component is ready, what's the stage or the common amenities when there's operational at that
So
stage?
historically, the first project, Rhythm Lonavala, was a ground-up development. So that was at sort of 30% construction phases when sales were started. However, given the COVID situation, as we mentioned, there are distress assets available. So there are assets that you could just buy and convert, which is a large part of the global thrust as well. Is you could convert non-hospitality real estate into hospitality, and you could take existing hospitality real estate, especially in countries like India where there's high interest rates, highly leveraged assets, and you could just break it up into equity investors. As Rocky Saab stated, you're anyways happy to pay a debt investor a certain rate, then why not pay a similar or lesser to an equity investor? So that is the strategy. If we can buy out existing assets, then you can start the sale process immediately.
Appreciate that. Mr. Israni, coming back to you, what's the profile of these typical investors who come and who's buying your asset? These are the people from that particular geography, or these are people who are coming from the metro cities, or they have a devotion for pilgrim location like Dwarka in your case. So what are the profile of these people?
So mix of all. These are certain are super HNIs. They are interested in yielding asset investments. They typically have commercial real estate. They have the residential real estate. Now this is part of their diversification into a hospitality strata sale product where they're more excited about the yield than the location. That is one type of it. The other is their devotional inclination towards the temple town. So this is mixed bag. Some of them are pure vacationers. They want to buy leisure destinations because this is their weekend home. They're very in close proximity to those locations. Of course, Dwarka doesn't fit into that investor criteria, but Lonavala and Udaipur and Gir Forest will fit into. Because they want a short haul destination, which is they can call it a second home, weekend homes, but they don't want to get the hassle of maintenance and leasing it out on Airbnbs of the world. They don't want the security hazards. They don't want the service issues there when they go there. They have to keep a cook. They have to keep the maintenance staff, security. It's not cost effective for somebody to own a weekend home these days. So they just own a strata sale hospitality product in these leisure destinations closer to their homes, as Tanvir said. And then what happens is they not only use for 21 days, but they use more than that. So they dip into their income out of the usage, excess usage. So we give them that opportunity. So what happens is if somebody wants to use for 30 days, what happens to the other 9 days that he used it over and above his allowance? So the 9 days of those days that he used, he has to pay the displaced RevPAR. He doesn't have to pay the rack rate. So if the rack rate was 10,000 and the RevPAR was only 4,000 on that night, he has to pay 4,000 rupees for that room night that the RevPAR that he displaced for the other owners.
Appreciate that. That's pretty insightful, Mr. Israni. Santhosh, coming to you, the financial institutions in the country right now have a very conservative view when it comes to hospitality. Okay, whether you are at any stage of development, they're very cautious, and especially even if we go to pre-COVID scenario, the gestation period of hospitality asset class is approximately 7 to 8 years, whereas the hospitality loans which we are getting from the even PSUs or the private banks is nothing more than 8 to 10 years. Okay, why? What's the reason when model like this has done pretty well in Western world or in Middle East? In India, we still haven't seen any major success stories or very limited success story, if I say so, on this particular business model. That's question number one. And second, do you think it's the right time for the developers to explore this particular module? And are we gonna see many more such developments coming up in next 3 to 4 years?
Okay. So the first part, which is why is it that this has not developed? So, I am reminded of what happened in this country about 30 years back when, some of the, should I say, well-known and not so well-known timeshare companies from around the world came to India. They came and marketed timeshare and obviously did not do well. They never executed well, and the people who bought the timeshare lost trust. Right, number one. Then you had a brand like Mahindra who came in, and obviously because of the brand Mahindra and the execution which has happened for the last 23 years, where Mahindra Holidays is and where vacation ownership is. Now take that, the same thing to Strata sale. What happened with us with this with the Strata sale bid 7, 8, 9 years back, 5 years back, with the developers in some parts of our country offering fixed returns, offering very high returns, and we all know this is a cyclical business. So we would mean the developers who promised this mucked it up again. Number one. The other part is, where are the established brands? And I'm not saying operator brands. Where are the established developer brands in this country doing this? You need established developer brands in this country to do this. A Godrej should be doing it. A Mahindra Group, I'm presuming we should be doing it at some point. So many of us who are established brands in the country should be doing it. A Hiranandani should do it, for example, correct? So I'm trying to say, when established brands do it and they're able to execute well, people will have the trust in those brands. So the execution has been patchy. There has been overpromise. There has been no transparency in what one can get. So as a result of which, what has happened in this entire case is we have fallen. And the other part is, obviously there was no regulation, correct? RERA also came in about like 2 years back, correct? How do I trust my money with somebody like that? So you have a list of these reasons why this is not developed, correct? What is the second part of the question, Nandi?
With now RERA in place, with you right now the current circumstances where the raising the finances for real estate or hospitality sector from the financial institution is going to be very difficult, or institutions going to have a very conservative view. Do you think this model is going to, picked up very well in this? It's going to be blessing in disguise for this particular business model?
Yeah. So So I will answer that. Just going back, one more point I remembered. One is about promising returns. It's easy for anybody to promise. How many of us have seen execution? Execution of pre-teen returns we are talking about. How many of us have seen it? Till I see it, I will not believe it. Meaning, I'm saying from an investor point of view. Now let's go back to the future. What can we do in this scenario? Is this the right model? Can it be done? In my view, definitely this is one solution, but this is not the be all and the end all of it. Let's be clear. From developer, when we look at it from developer's point of view, what does a developer do in a typical hotel? They take 50%, 60%, 70% debt, and that's the killer in our industry, correct? What are we doing here by this model? We are replacing corporate debt with retail debt. In that sense, it's not debt, it is investors' money. So as a result, what happens is the corporate debt, the debt or bridge debt comes down, which has to be manageable, which has to be really manageable to be able to make it work. But the other important bit here is to have skin in the game, correct? I do not believe, from my point of view, and from Mahindra Holidays point of view, I can say this, that if a and we have developers developing this for us, definitely we will not have a situation where a developer can develop 100% of the rooms and the public areas. In fact, I have met a developer who even wanted to sell the clubhouse. I'm seriously saying it. We had a discussion. I was like, meaning, come on. So that mindset, the moment that changes, and we see that it is all of us are here for the long term. We have skin in the game. There is a brand. We are able to execute. I see no reason, why this model should not be used. It is not a developer's short-term model. That should be understood.
Very well said. Really appreciate, Santhosh, your insights on this. So, Santhosh, it's a very important point that this model in the past didn't work because of the trust factor, or because of the past some companies which have made a play in this entire segment. Do you think with having a branded operator on board, it adds credibility to the project and it helps, for the developer to sell the stock to the retail investors easily and take it back on a lease back module? So what's your experience in your projects? Does that help in your Bangalore, in your other projects?
So a couple of points. If I just move back a little bit in terms of the city sale versus the leisure sale, We've had a couple of properties in the city sale, and we found that the sale of those projects, they've been relatively easy for the developers to sell those hotels because of what Tanveer says. They're close, people can come and see it. It's considered as an investment for them. Versus where if they had to buy a second flat, they would also have to pay maintenance charges. Those maintenance charges also now get incorporated within your return. So you're getting a significant return to that as well. In terms of, where we are for whether an operator makes a difference for the sale, definitely an operator makes a difference for the sale. But does it improve the trust factor? It will give an initial trust factor improvement. But where Santhosh is coming in is that the trust factor has to be primarily with the developer of the property, because they're the ones that are issuing the return guarantee. Okay, whether it's in the form of a revenue share, a guaranteed fixed return, which is probably the worst way to go. But they're the ones that are, sticking their neck out in this term. So the trust factor needs to be there with the developer. The brand will, kind of lend to that trust factor, but the brand really holds no liability with regards to this aspect. Another thing we actually have to consider, and one of the challenges which has affected the trust factor is, in the kind of properties that have been converted. A lot of the properties that have been attempted in this are kind of residential products. And, without the proper licensing and documentation in place to use it as a commercial infrastructure. So that's something that we have to look out for. And that's something that as a brand, one of our preconditions, that the property has to be commercial use. We have to retain the public areas and the restaurant facilities. Though internationally, I do believe there are quite a few projects that give return even on the public areas and restaurants as well.
Interesting. Okay, gentlemen, I have a... Sorry, go ahead, sir. Please finish.
So I said these are the two preconditions that we have for, couple of the preconditions that we have before we take on such project.
Okay, thanks. So, gentlemen, I'm now going to take advice from all of you on one simple, that what's your advice to the real estate developer if they intend or they're exploring to develop a project on a fiscal business module, from the operator's perspective, from the finance perspective, and from the developer perspective? What's your point of view on that? And after that, I'm going to open the session for the questions from the audience. So we'll start with you.
Sure. So from a developer's angle, we all know the hospitality and hotel industry is extremely capital intensive. It takes you a long time to kind of recover that capital. This is your best solution to recovering a large portion of your capital and still enjoying the credibility of the product and the upside return of a performance. So there is really a huge future for this in terms of where developers will see it. And like Santhosh mentioned also, it is the big developer houses, once they start getting into this, you're going to see the game changer here in this aspect.
Thanks, Sohail. Mr. Israni, from your side?
I think the developers should, more and more developers should get into, if they have the aspiration to get into the hospitality business, they should try this out. But I suggest they should have the complete financial closure before they start selling, and not relying on these pre-sales money from the strata sales. Because I see this can give a very bad image and reputation to this asset class. I'm seeing a lot of projects on paper trying to get 10%, 20% first sales of the strata sales, and then getting stuck because the construction progress is not there on those projects. So they're neither here nor there, and 10, 20% of the customers are stuck, and the developer is also stuck there. So my personal one recommendation, it is, if you ask me one single suggestion, is unless they have a complete financial closure without the pre-sale money from strata sales, then only they should venture into this concept.
Thanks for being candid, but that's pretty insightful. Nikhil, your side?
So I think from a law perspective, most countries in the West have a strata title law, which basically has no ambiguity for the developer, for the investor, for the exit clause, and so on and so forth, right? So we definitely need a strata sale title law in this country to some extent. It really will clarify the ambiguity that we've spoken of. That's one. And everything that Sohail and Mr. Israni said, just one addition is that the developer needs to tweak the model. Strata sale is typically a second home or an investment in leisure locations because the investor believes he will or she will spend some time in that place. Our experience that we are seeing that in urban cities as well. Of course, leaving the gateway cities, Singapore, London, Dubai. The difference in urban cities is the model does tweak itself. It does come with a kitchenette and a little more space than what you would have in leisure locations. So that mix does change there. Mr. Israni, you want to add something?
Yeah. So, adding to what Nikhil said, just, out of curiosity, a lot of people have asked me this. There's a difference between fractured ownership and strata ownership, which a lot of people don't understand in India. We should clarify that also. Fractured ownership is one unit sold to 10 people, fractured into 10 pieces, versus out of 100 units, each unit sold to a separate investor is strata sale. Strata sale ownership laws are very clearly defined here in India. It is as good as you selling a real estate, which is residential or commercial. This is just a purpose-built real estate. So strata sale title is not an issue. People should not worry about it. It's the fractured title which they should worry about.
Yes, absolutely.
Santhosh?
So my one advice for developers is, like I mentioned, this is not the cure for all your liquidity problems. This is not a develop and exit model, like I said. Hence, think, plan, execute long term, create a track record of investor returns, I would say. That's your best guarantee. That's your brand. Nothing else is your brand, From investors' point of view, for investors or retail investors who invest, I would go do the same thing. Do not go to any developer who offers you fixed returns, or if he gives you fixed returns for a small period of time, or a very low fixed return, then it makes sense because the underlying business model has a business cycle. It's as simple as that. That's what I would say.
Yeah, so for the ecosystem, I think there's two main players, right? There's the developer and there's the unit investor. One advice for the unit investor is definitely to go with developers and operators with a track record. Trust is key, and that trust is developed over at least 4 to 5 years, showing the strata sale and lease back and that lease returns, right? A lease is as good as the returns. So it is a lease play, and investors should understand, look at the rent rolls and look at the payments that the developer or operator have made over the past few years to their investors. So for the investors, it is ask the trust question. Don't get carried away by the asset or by the location, which in hospitality is easy, right? Especially in leisure hospitality. You go to a nice hotel in a Goa type location, it's easy to just feel, ye to chalega, kuch na kuch ho jayega. You have the operator and the developer in the middle. So it's not you fully owning it, and you're giving it away for 15 years. So you do need to have that trust factor. That 15 years should weigh strongly on the investor mind. And then on the other side, the developer or the builder and seller, again, the same thing. You're giving a promise to hundreds of investors for 15 years. Sabko saath leke chalna hai. So if you're going to have, let's say, 5 or 6 assets, you have 500-600 investors, which is very different from dealing with 1 or 2 banks. So the difference between taking debt and retail investors is you're going to deal with 400-500 families. So the numbers, be honest to them. It's as others have stated on this call, it's very obvious that it's primarily only room revenue that the developer can share, largely speaking. Thoda F&B या कुछ अगर कर दिया तो बहुत अच्छा है, but you should question that, because from the developer side as well, the economics really work out with room revenue and less than half. So 50% or less of the room revenue is going to be shared in a pooled vehicle. So almost everyone believes and agrees that if you're going to run it for 10-15 years, if I have room number 101, if that is shut for 2 months, doesn't mean I don't get any revenue. Everyone has to share. So the developers need to be honest to themselves, saying, how much can I really promise to hundreds of investors for 15 years? Because anything that you say, any number that you say, that's why we've kept it to the high single digits, so less than 10%. 8 to 9% is where we think you can long-term give a yield. this does not take into account the capital appreciation. So in 4 or 5 years, when the hotel becomes a great hotel and the whole hotel is sold, or your room is sold, or your asset is sold in the secondary market, you'll get a capital appreciation which you could add into your pro forma and give, as Rakesh has mentioned, 13-14% as a total return over a 5 to 10 year hold period. So developers, as Santhosh has mentioned, do get excited in the sale process and promise long numbers or big numbers with caveats, etc. ये सब चलता है जब एक बार सेल करके आपको निकल जाना है रेजिडेंशियल में. In this hospitality, you're in with the. He's a partner, and most developers also should realize that they'll need to own or continue owning at least the common areas, the F&B, the gym, etc. So they are invested, plus probably 20 to 30% of the room inventory as well. So everyone's in it together for 15 years over multiple assets. So be honest with the numbers and the commitments that you make to the market.
That was insightful. Mr. Israni, you wanted to say something in between? Please go ahead.
Yeah, that's exactly what I meant when I said that the investor gets a 10-year pro forma. That includes the terminal value of exit of his investment to make that 14-15% return. It's not a yield. He's right. Tanvir is absolutely right. So when we tell the investors that you can make up to 14-15%, that includes the back-ended capital appreciation of 5-6% annualized, back-ended.
Appreciate it. Great, gentlemen. Thanks a lot for your input. Now I'm opening up the session for the Q&A. And the first question I have from one of the audience is this, that if a retail investor invests in the Strata sale module, where he's buying a villa or a room, how easy or difficult for him to exit out of this after 2 years, 3 years? In any of your project, which is more than 3 to 5 years, have you experienced where the investors have managed to sell that stock easily after the operations from 3 to 5 years? Tanvir, your project is, I believe, 5 years old. Would you like to take it up?
So in Rhythm, there have been secondary sale. And I think, as was mentioned, the strata sale law exists. And you can see it in commercial offices. You can see it in shopping malls. So if you do it like a normal asset where the full title deed is controlled and owned by the investor, he can sell it like any asset. So in Rhythm, we have had secondary sales, both in the open market where the investor has gone and sold it independently, and where they've come back to Rhythm saying, since you're in the game, if there are new investors that are interested, I'd like to exit. And people have gotten an exit, and we found them new investors.
His corresponding question is that what type of returns they have managed to achieve once they exited?
It's the numbers that we discussed. So 8 to 9% yield over the 3-4 year hold period on a quarterly basis it's paid out, plus the 5 to 6% annualized capital appreciation.
Great. Another question. These projects all are RERA registered. Mr. Israni, would you like to take this up?
So yes.
In your case, all these projects which are coming.
So all projects have to be RERA registered. Absolutely.
It's by law. It has.
Yeah.
That's right.
By law.
Great. So, Sohail, another question for you. As an operator, do you feel that at times it gets very challenging, or you get an opportunity to speak with multiple investors during your operations, if that happens?
No, as I said, for all the properties that we have, the developer is the one who's retained a significant portion of the inventory, and whatever inventory that is sold and leased back is leased back to the developer. So from an operator perspective, you're still only dealing with the developer, and you're not dealing with the individual asset owners. It's the developer who's dealing with the asset owners.
Great. Santhosh, another question for you. This is specific to you. That is there any plans as Mahindra Hotels and Resorts are planning to come up in Strata sales?
So from Mahindra, we are in 3 parts. So we have 3 different things happening for us, right? We own resorts, we lease resorts, we will start managing resorts and hotels. So there are all the 3 parts for us. In owning resorts, which is Mahindra Hotels, Mahindra Holidays, a part of the Mahindra Holidays core vacation ownership business. I cannot right now commit to you that we are planning to do that as a listed company. I would be giving guidance, so that's not fair on my part from our perspective. From a management, from a leasing point of view, like I said, we are already doing that. So it's getting. I think the resort is opening next month. We have 2 other projects being considered. So that's happening. The resort where I'm sitting is also where Strata sale has happened, and it is an operation, and that's something which we intend to take up. In terms of management, we will be very open to do that anyway. So I see the point is you need to have guardrails. Like Tanveer said, the skin in the game is important. Not promising fixed returns is important. And long-termism is very, very important. So as long as one can see, eye to eye, we will definitely be keen to partner developers who would want to do, along with us. We'll be very happy to do it.
Thanks. Another question. This is the last one. There's a long list of questions, but I'm picking up this as the last. We only at 4 p.m. You panelists feel that there is an opportunity for this particular business model in tier 2 and 3 cities of our country? Mr. Israni, Tanveer, any one of you can.
Not in tier 2 and tier 3 cities. It's in leisure destinations and tier 1 cities. Business districts, business cities, yes, and leisure destinations, yes.
I would absolutely second that, because tier 3 cities, the real estate cost itself is so low that it wouldn't make sense for someone to do this as a strata sale. This is primarily tier 1 and leisure.
Thank you, guys.
Go ahead, please finish. Go ahead.
I'm done. Sorry.
You're good. Done. Thank you, gentlemen. Thanks a lot for your great insights. It's been very fabulous to chat with all of you again. And once again, we respect your point of view, and I'm sure it's gonna be wonderful, views gonna be shared with the entire community of our investors and the developers and the operators from our various social channels. And thanks a lot once again. Thank you, Tanveer. Thank you, Sohail. Thank you, Santhosh, Nikhil, and Rocky, sir. Thanks a lot.
Thank you all.
Thank you.
Bye.